investing, we usually focus on the numbers, right? Company fundamentals, market trends, all that good stuff. But what if I told you the single biggest factor influencing your choices isn't on any chart? It's right here, inside your own head. Today, we're going to dive into that human element, how our own emotions can secretly steer our financial decisions. Seriously, think about that for a second. You can have all the data, all the analysis in the world spread out in front of you, but when it's time to actually pull the trigger, to buy or to sell, what's really pushing you to make that click? As we're about to see, pure, cold logic, well, it isn't always in the driver's seat. It's kind of like every investor has these two advisors in their head, constantly talking. On one side, you've got the analytical mind. That's your strategist, the one who's all about data, plans, and long-term goals. But on the other side, you've got the emotional instinct, and that part runs on gut feelings, impulses, and what feels right now. The real battle for our portfolio is often fought in that space between these two voices. All right, so let's jump into our first big scenario. We're going to look at what actually happens to our thinking when the market starts to drop and all you can see is a sea of red on the screen. So imagine the market's been doing just fine, and then suddenly it takes a nosedive. That sharp drop, you see, it's way more than just a data point on a graph. To our brains, it's a potential threat. That moment right there is what we can call a fear trigger, and it kicks off a really powerful, really primal emotional response. And once that fear trigger gets pulled, a very particular voice can get incredibly loud in your head. It's the voice of fear. And it's not whispering calm, rational doubts. No, it's shouting worst-case scenarios. It's like hearing a loud crash in the other room at 3 a.m. Your first instinct isn't to calmly analyze the source of the sound, right? It's to react. That's exactly what this voice is telling you to do. The result of all that fear is something we call panic selling. Now, the most important words here are impulsively and not part of a strategy. This isn't a calculated move. It's a pure reaction, and it's driven by one thing, the desire to make that awful, uncomfortable feeling of fear just go away. Okay, now let's flip this whole thing on its head. What happens when the market is soaring, when everything's going up? Well, the emotional forces are just as strong, but believe me, they wear a very different mask. Now, this is the kind of chart we all love to see, right? Prices are climbing, but just like a big drop can trigger fear, a rapid climb can trigger an equally potent emotion. We can call this the greed trigger, though, to be fair, it also includes feelings like excitement and that powerful fear of missing out, or FOMO. And when this trigger gets pulled, that voice in your head sounds totally different. It's confident, it's urgent, and it's pretty much ignoring any idea of risk. You know, it's that same impulse that makes you want to buy something you don't really need during a big sale, just because it's popular and it feels like a can't-miss opportunity. Your focus shifts completely from the strategy to the pure thrill of winning. And all that excitement? Well, it can morph into overconfidence, and it can do it really, really fast. This is a tricky mental state to be in because your past wins suddenly feel like a guarantee of future success. The most dangerous part here is the underestimation of risk. That emotional high can make us completely forget that things can, and do, go down too. Okay, so we've got these two powerful forces, fear and greed. Now let's really break it down. Let's look at the anatomy of a decision, comparing the path you take when you're emotional versus a calmer, more structured approach. The path of an emotional decision is, well, it's incredibly short and fast. Step 1, you see the market move. Step 2, you feel a really strong emotion, like fear. And bam, step 3, you act immediately. But notice the goal of step 3 isn't to make a good investment. The goal is to make the bad feeling from step 2 stop. It's all about emotional relief. Now, let's compare that to the path of a calm decision. The trigger in step 1 is exactly the same. The market moves. But look at step 2. You don't just feel the emotion, you acknowledge it. That little step creates a crucial pause. And in that pause, that's where you consult your original plan. That's what ensures your final action is based on your strategy, not just on a feeling that will pass. So, after going through all this, what's the big takeaway? What are you supposed to do? The goal here isn't to try to become some kind of robot that doesn't feel anything. No, it's something much more realistic and, frankly, much more effective. This says it all, doesn't it? Feeling fear when things are dropping or excitement when they're rising, that's totally normal. Those feelings aren't the enemy. The real problem is the unaware reaction to them. It's acting on that signal without even thinking. So really, this is the whole point. The goal is to learn how to be the observer of your emotions, not just an immediate follower. It's about being able to notice that fear or greed bubbling up and just say, okay, there you are, without instantly doing what it tells you to do. That little bit of space you create between the feeling and the action, that is everything. That space is where a knee-jerk reaction transforms into a thought-out decision. So, awareness is the real goal. And if you're finding this helpful and following the series step by step, you can subscribe to NeuralTarot to make sure you don't miss what's next. Now that we're aware of these powerful emotional forces, the next logical question is, okay, so what do we do about it? How do we build the habits to navigate this stuff? Well, in our next explainer, we'll get into just that, understanding how beginners can build disciplined decision-making habits.